Thank you very much. Hello, this is Marc Bergmann. Welcome to today's Q1 earnings call with CTS Eventim. You have Holger Hohmein, CFO, on the call, and myself. Holger will now start with presenting the Q1 financials, and after that we'll open the floor for Q&A. With that everything being said, I'll hand over to Holger.
Thanks, Marco. Hello, everyone. Let's start right away with the key takeaways for the first quarter. We have seen a solid performance in the first quarter, as expected. Nothing unusual. In ticketing, of course, we have seen the growth primarily coming from the newly consolidated acquisitions. You're aware of that we have acquired C-Tickets and France Billet last year, and for the first time we have them fully consolidated in a first quarter. Also, we have seen growth in existing business, slight growth versus previous year. So we have some technical issues here on our end, so I'm a little bit confused here. Okay, I try to continue here. So we've seen slightly higher growth in existing business as well, despite having had a very strong first quarter last year. You might remember we had a very strong first quarter last year with on sales like AC/DC and Adele, which we haven't seen so far this year in the first quarter. In live, we have seen a very pleasing growth. Also, the first quarter never is a strong quarter in the live entertainment business. The music typically plays in the second and third quarter. But most importantly, here, last point on this page, we confirm our guidance for 25 as a whole. Let's now look at some of our KPIs on the next page. Here we are. Revenue came out just under 500 million euro, which is an increase of 22% versus previous year. Adjusted EBITDA came out just over 100 million. There was nothing to adjust in this first quarter, so adjusted EBITDA is the same as normal EBITDA. The number of retail tickets, and you will remember we have changed the metric beginning of this year slightly. Number of retail tickets has increased by 42%, and we come to this in a minute. So growth in tickets outside Germany, outside our home market, was even stronger with an up of 71%. And again, we come to this in a minute. Which is new on this slide here is the 12 months rolling GTV, the gross transaction value. This increased to 8.2 billion, which is a 7.2% increase versus the last quarter or last 12 months, rolling 12 months. Let's now look at some more group numbers in more detail. On the next page, as said, revenues came out at 500 million, and this was driven by growth in both segments, live and live entertainment and ticketing. And of course, in ticketing also was driven by the consolidation of France Billet and C-Tickets numbers for the first time for a first quarter. The EBITDA came out at 100.3 million, which is almost 14 million higher than last year, or in an increase of 9%. The margin is slightly lower than last year, and again, want to remind you, we had a very strong first quarter last year, which we haven't seen, or at least we have not seen some major on sales in the first quarter this year. And you know, we have always ticketing is always a timing. We always have this timing effect. If an on sale starts in one quarter or another, and sometimes there are some delays in some shows. What we have also seen in the first quarter is some integration costs for new acquisitions. You will be aware the work starts only after the closing of an acquisition. Then the work starts, and then typically all the integration costs incur. Again, we confirm the guidance for the whole year, so nothing to worry about for the moment. EBIT came out at 76.2 million for the first quarter. What is not displayed here, but what you might be interested in, is looking at the transition to earnings before tax, which you will see on the next page. Here you can see the bridge for the earnings before tax for the first quarter this year versus first quarter last year. Earnings before tax was 72 million in first quarter this year compared to 95 million last year. So EBIT, earnings before tax was 23 million lower than last year. And the reasons for this are threefold. We have seen FX effects in the financial results around 40 million as this effect, and mainly coming from the US dollar, of course, and you might be fully aware of the reason behind that. Second reason is last year we had in the first quarter still some dividend coming from the order ticket, which was our car toll project, where we got some compensation in the year 23, and then which resulted in some dividend payouts in the first quarter last year. And the third reason for the lower financial result is the slightly lower interest income, which is a result of the changed interest rate environment. I think this might be of interest to you to understand the bridge here to the EBIT. Now back to the operating results. We start as always with ticketing, which you can see here on this slide. We have seen the highest revenue in ticketing for a first quarter ever. The revenue came out at 214 million for the first quarter, which is a growth of 17% year over year. Again, mainly coming from the fully consolidation of the newly acquired businesses, France Billet and C-Tickets. But again, also we are seeing moderate growth in the existing business, as already mentioned, not to forget the very strong quarter last year, first quarter last year, which we haven't seen so far this year. I think that's it for a moment. Let's have a closer look at the value driver, the driver behind the ticketing revenues and results, which is the number of tickets, of course. And as I already mentioned, we have changed the metric a little bit beginning of this year. We now report the retail tickets, which is not only tickets sold via our own online channels, but also sold via partner channels. So you might be aware of the change methodology. For the first quarter, we ended up with 40 million retail tickets in the first quarter, which is an increase of 42%. On the right-hand side, you can see the distribution by regions. The growth has been especially strong outside Germany, while we are still seeing growth in Germany, but the growth mainly came from other parts of the world. And the share of international markets is increasing over time, and with maybe more acquisitions to come in future, this will continue, or this trend will continue. Let's now look at our other segment Live Entertainment. In Live Entertainment, we have seen a very pleasant development here. Also, again, highest revenue in the first quarter ever, and this came purely from organic growth, nothing specific what stood out here. We profit or we benefit here from the breadth and depth of our portfolio. Nothing specific to report here in this quarter. Typically, the first quarter in Live Entertainment is not the strongest one, as you might be aware of. We have this cyclicality of the business, and the music typically plays literally in the second and third quarter. So we will see here more in the next 2 quarters. That's basically for the moment. That's it. And now we would be happy to answer your question.
Thank you very much. Ladies and gentlemen, if you would like to ask a question, please press 9 and star on your telephone keypad. In case you wish to withdraw your question, please press 9 and star again. Please press 9 and star to register for a question. And The first question comes from Olivier Calvet from UBS. Over to you.
Yes, many thanks for taking my questions. I've got a couple. The first one, more of a big picture one. Your main global competitor has disclosed its involvement in a possible venue in the south of Germany. I was just curious as to, your thoughts on this, please. The second one would be on the second quarter to date, just wondering how material on sales you have seen so far this quarter, Lady Gaga, maybe Chris Brown as well, are. The third question would be on the free cash flow burn in the first quarter, notably with very high working capital and headwind. How should we expect this to develop going forward through the year? And the last one would be just on France Billet and CTS. Are they performing as you'd expect, and how happy are you, with the profitability at each of the two?
Thanks. Maybe I start with the last question. Well, are we happy with the acquisition? Of course we are. But as said earlier, the work then always starts after the acquisition, after the closing. And of course, there's a couple of things, or a lot of things which have to be done. And it's a lot of work which results in also higher integration costs. And also on the business side, you might lose the one or the other customer, or have maybe a slight change in your product portfolio. But overall, of course, we are still happy with the acquisition. Then there was a question on free cash flow. No.
Well, apart from the normal seasonality that, of course, after you have accumulated the cash from early ticket sales in Q3 and Q4, that now this whole thing reverses as you pay out the cash mostly as shows take place, or you forward the cash to third-party promoters. That is the usual seasonal pattern you see at the beginning of the year in the first quarter. Second quarter, we have seen some great names, but as we said earlier as well, that it's not dependent on individual timing. Company has reiterated its full year guidance, so we remain confident for this year, particularly towards the second half, when we come more and more into the period when we start selling shows for next year's touring season. So from that perspective, there was this positive outlier last year in Q1, which did not reoccur again this year. But we have seen some names already in Q2. But as always, as we said, it's over when the fat lady sings, and this is for us Q4. The first question with regards to Live Nation's engagement in the venue development in Munich. We're not too fully aware about where the status is, but what we know is that, of course, that Live Nation has partnered with someone who's bidding to build this arena. But as much as I know, we're still far away from any exclusivity or any final agreement there. And as we have all learned that since Taylor Swift was on tour, that there are plenty of mayors in Europe who would love to have a big shiny venue, so that the next time when she's coming, that they all could welcome her in their city. But overall, Live Nation, being a company that is globally much more involved in building and operating venues and owning venues, and as much as I remember, Michael Rapino said that until 2030, that they want to invest something north of 4 billion in global venue development. So it's not a surprise that wherever there is an idea in a city to build a new venue, that they will have a look at it.
Okay, thanks. And just on France Billet and CTS, just if you could position each of them, in terms of where you are in the integration. I would assume France Billet is a bit further along, but is that wrong?
Yeah, right. We have acquired the first stake in France Billet already back in 2019, if I'm not wrong. So yes, there has been done quite a bit of work already, but On the other hand side, now having fully control since November or December last year gives us now the leverage to also integrate on other parts of the value chain. Yes, we are a little bit farther than with e-tickets, and there are tons of things to integrate and to optimize and to align, not only on the product side, but also on the back end or back office side. And some things are, a little bit faster. Other things take some time because also of other priorities. So, I mean, nothing what the company is not, used to do, because we had multiple acquisitions in the past, and this is something which Eventim is quite used to. But it would not be fair to say it's all done within a couple of months. So some things take a little bit longer to really exploit all synergies.
Okay, thanks.
And next up is Annick Maas from Bernstein.
Hi, good afternoon. So my first question is on these integration costs for Frontier and C-Tickets. I estimate there were about 5 million in the first quarter. Shall I estimate the same level in the second quarter? And then, as you said, in 2 months it should be done. So that's going to be it for the rest of the year. The next one is if you could just go over the comparatives for US live entertainment for the rest of the year each quarter, please. Then one on the pipeline for 26. So I guess you just said that on-site is going to become better in the second half. I assume that's related to the pipeline for 26. Can you maybe give us a bit more of an indication if that's going to be 3Q or 4Q weighted? And then just last one on financial result. How do you think about the financial result actually for the full year when you model it internally? Thank you.
Thanks. On the integration cost, I mean, the order of magnitude is probably a good estimate. I think this might also be a good estimate for the next quarters. I didn't say we are done within the next 3 months. I said quite the opposite. I said it's not done within 3 months. It might take a little bit longer. Parts of it are done easily in terms of, when you think of management, for instance, it's not something that takes very long. But if it comes to integrating some back-end, let's say, ERP systems or so, those things can sometimes take a little longer. So it's quite obvious it's not done within 3 months, but will hopefully mostly done by end of this year, with maybe some spillovers to next year. But your estimate for a quarter sounds quite reasonably to me. In terms of financial results, well, there's always, we can hardly predict, FX rates, and as we already have a decent portfolio outside of Europe and outside of the Eurozone, in South America and North America, where we have quite a lot of exposure in US dollar. We depend a little bit on the FX rates development there. And this is always reflected in the financial results. But I would expect this, I would say, in a low or mid-size 2-digit million number. This would be a reasonable estimate, I would say. But again, things can also reverse. But let's say a low to mid-size 2-digit million number for the financial result would be a good estimate. Then what's the question? What was it? The pipeline? I think Marco.
Yeah, I mean, it's of course, hi Annick. It's not really our call to determine when shows go on sale, but of course, as we move throughout 2025 and the closer we come to the second half, the more, of course, the ticketing pipeline fills for shows that are scheduled for 2026. Yeah, it's hard to say, of course, what might come still. Whatever end September and what might go on sale in October, because these are decisions that are fully made by the promoter who owns basically the show, and when we get the green light to go on sale. But all in all, I think we can say that this year is very well scheduled to have the ordinary seasonality in ticketing, which we knew from other years. Yeah, so it's back end loaded, hard to judge. on a relative basis, whether Q4 will be relatively stronger than in previous years. We had a very strong Q4 last year, or how it compares to a Q3. And of course, in all honesty, I know that if you want to model it quarterly, it's very important, but of course, we couldn't care less whether we sell a big show in September or beginning of October.
Okay, thanks. And then just in the comps for US live entertainment for the year, that would be great.
Sorry, was the question how the previous year has been as a basis?
Yes, exactly.
or what's
how
to
the
come?
comparative, no. How the comparative last year, each quarter have been for the US live entertainment business, as that's now, a meaningful driver, I guess, of live entertainment.
Oh, no. I mean, it's a very nice way in asking of what we expect in this year to come, because when you ask how we look at last year's basis and how it compares to X, yeah. I mean, we went through it last year. We have been way more focused in our live entertainment activities in the US, and not just as we were maybe in the growth phase where as it said, we were growing and where we were supporting our partners there to sign various deals. Yeah, the focus is now on profitability and optimizing the hit and miss ratio in their portfolio. And I think what we can say is that this year we strive for optimizing that mix over last year. Yeah, but it's hard to say on a quarterly basis, because if you remember in the second half last year, we had the situation that we had pre-incurred expenses, for example, in the Q3, which caused questions, because it had an impact on the profitability in live, which was then fully covered in the fourth quarter. Yeah, and this again is of course something which is hard to judge because it does not follow a payment plan which we set up at the beginning of the year. But all in all, we are happy with our activities there. We focus on being profitable. And it's always the question of whether you deploy more to grow the business there, because as we all know, the US is a market where you usually have to pay in advance and then recover the money. So, and we try to be as diligent as we can be, not to be overly exposed in a growth part where we might not recover the money in an acceptable time frame.
Sounds good. Okay, thank you.
Thank you.
And next up is Gerhard Orgonas from Berenberg.
Good morning. Could you tell us the EBITDA contribution in ticketing from M&A before and after integration costs, please?
Did I get it correctly? You want to have the exact integration costs included in the EBITDA?
The EBITDA from C-Tickets and from BA in Q1.
No, not sure if we want to disclose this here in such detail, but it's a mid to high one-digit number, EBITDA number.
And that is after the 5 million integration costs or before?
Well, integration costs can incur within France BA, and C-Tickets can also incur here on central level in a headquarter. So it's included everywhere a little bit, yeah.
Right. Okay. Thank you.
And the next question comes from Craig Abbott from Kepler Cheuvreux.
Yes, good afternoon. Yeah, I just have several questions actually. One, just to kind of get back to the phasing of these integration, restructuring costs, and so forth. So it sounds like you're going to have a similar figure in Q1, and then it sounds like these will start to trend down in H2, but you may still have some. But at the same time, in your Q1 report, it says you're clearly expecting synergy gains from both acquisitions to start increasingly feeding through also as you progress through the year. So I just wondered if you could at least give us a ballpark range, kind of what you're looking at in terms of that EBITDA margin progression at the two units, looking out over the next quarters. Secondly, on ticketing, I'd like to get back to Q2 again, please, because obviously you now have 2 months nearly in the books. If you could give us some kind of indication of what you've seen in terms of year-on-year growth and kind of a margin comparison, just so we, can have a better feel for what we kind of expect for that quarter, and including if there are any base effects we should be aware of. Third one is just, on the guidance. I mean, you say you're confirming it, but the actual official wording, of course, remains very vague. But in the full year conference call, you provided more color and stated, you were quite comfortable at that stage with, full year consensus numbers. We were seeing at that time, I think, something like 3.2 million top line and sort of around 600 million EBITDA. If you could just, if possible, if you can give an update on your thoughts there. And finally, it's just on the CapEx. Quite a big number in the first quarter. Obviously, you're in the final stages of Milan now. If you could give us an update on what we should expect for CapEx for the full year. Thank you.
Okay, thanks, Frank. Maybe start with right from the top, integration synergies. Well, when we acquired CTS, I think we gave some numbers. Last year, we acquired a business of roughly 100 million of revenues and 25 million of EBITDA, which gives us a EBITDA margin of 25%. In our ticketing business in general, we have a margin, let's say, mid-40s, let's say 45% EBITDA margin. This is definitely the target to go for. Whether we will reach 41, 42, or 45, or maybe even higher, or maybe only 39%, we will see. It remains to be seen. But it shows there's some room for improvement. Yeah, let me put it this way, and I leave it with you to model something in this direction. Yeah? For ticketing, the second quarter, I think we will not disclose for the moment anything. I think we want to be quiet on this front. Looking at Marco.
Yeah, I mean it's difficult to make a statement here while we're still in that quarter. Yeah, and of course I think what is fair if we look at the rearview mirror that for example if we go back to Q2 last year, that as much as I recall there haven't been any big blockbusters. Yeah, so from what we can say here is that by what we have discussed over the last couple of quarters with big blockbusters in one or the other quarter, that Q2 last year was not necessarily a quarter with the two biggest blockbusters in the sales pipeline.
But coming on to the third question, which was the guidance, yes, you're right. I think in our annual earnings call, we gave some more, showed a little bit more legs, so to say. We said the overall revenue should definitely exceed the 3 billion, and for the EBITDA, we said we would be very pleased if we see a 600 plus million in adjusted EBITDA, and yeah, we would confirm this today. And on CapEx, there will be some more CapEx over the course of the year. So Milan construction is in full swing. I would expect, I think we should expect some, I don't know, not sure what we give here as a number.
I mean, would it be above last year's figure? Would be kind of in line, which was already, running above average because of the Milan construction. Just trying to get a ballpark figure, not looking for any kind of precise figure. If my understanding is the Milan will be completed this year, and then we will see that number tail off quite materially from next year, and then eventually a couple of years out, then the Vienna arena capex will start to kick in.
Yeah, I mean a good estimate would be taking the first quarter number and then moving it forward for the next 2-3 quarters, and I think it's a good estimate for the moment.
Okay, but for next year and 27, maybe we can expect kind of a normalization. Would that be a fair assumption?
No, for the moment, for next year, we do not, for the moment, we do not have a close deal, so to say, also not for the Vienna arena. So for the next year, we do not expect major CapEx.
Okay. And is the Milan, you're still on track there to open as scheduled, correct?
This is the plan. And I'm looking forward to see the Olympic ice hockey games then in February next year in Milan.
Oh, and just another question, please. When did the on sales for the LA Olympic Games begin? That starts in 26, right? That's 26.
I think it's spring 26, as far as I know. I'm not 100% sure, but I think it's spring, summer 26, yes.
Okay. Thank you.
And the next question comes from Bernd from Barclays.
Morning. Thanks, everyone. First one on ticketing margins. To what extent was the lower ticketing margin driven by France B and C ticket, and what was the underlying margin development? And perhaps what margin dilution do you kind of expect for the full year? Then on ticketing growth, perhaps, can we get a bit more color there? What does moderate growth in ticketing mean? So what was the underlying growth ex the consolidation effects from France B and C tickets? Then on the financial results, you spoke about some of the moving parts already and expectation for the full year, but perhaps just on Q1, what drove the higher financial expenses at around 14 million? And then finally, one from me, the effective tax rate was 34% for the quarter. What drove this? Was it mostly consolidation effects? And what are you guiding for on tax for the full year? Thank you very much.
Thanks. I think tax is the easiest one because I simply don't know for the moment. I would have to calculate myself. But there was nothing unusual. I think it needs to be a technical effect, and then we come to you back, or we can take this offline and come back to you separately on the tax side. What was the
financial result as we covered it in the presentation? Yeah.
Yes. Financial result easy. So we went down, financial result went down by, or decreased by 32 or 33 million compared to first quarter last year, and the main effects were FX, so US dollar has weakened, as you might be aware of. The second effect was we did not receive a dividend payout from Order Ticket, which was our joint venture for the Cartel project in Germany, which has been closed down, or we got compensation in 23, and then this resulted in a dividend paid out in the first quarter 24. This did not incur this year in the first quarter. It was another 40 million the FX effect, and then roughly 3 million lower interest income due to the changed interest rate environment. So this very much explains the difference in the financial results. And then I think you had two questions regarding the ticketing margin and ticketing growth. Yeah. So moderate growth, I mean, without the newly fully consolidated ticketing companies, the growth was, again, versus a very, very strong first quarter last year, was roughly in a low single-digit growth number. 2 or 3 percentage point, 2 or 3% in this way. And then there was a question on ticketing margin, though.
Yeah, the dilution from the integration. I mean,
no,
okay. So as we've laid out, there are some revenues in there in Q1 from first-time consolidation, and we have said something about the EBITDA contribution, which was, of course, net of integration costs, which tells you that, of course, the consolidation effect had a dilutive impact on our profitability in the first quarter. And of course, what we have to keep in mind is that we are comparing it here with the quarter last year that had a very strong and positive outlier that bolstered the profitability last year in comparison. Yeah. doing the math, I mean, we know that, for example, take C, as Holger elaborated on earlier, which is on its standalone, a business that generates a ticketing margin somewhere in the low to mid 20% EBITDA. If you add that in, you see that you probably, on a back of the envelope math, have some kind of easily 200, 300 basis points dilution. Yeah. And this is, of course, something, as to give you an indication, last year you probably had easily 200 to 300 basis points addition due to a strong or two blockbuster artists which we have sold in Q1, which did not reoccur this year. And this year you have some 200 to 300 basis points dilution because of the standalone business plus the integration cost. And as we have said, that this will fade out throughout the end of the year. Yeah, there will still be integration efforts, but of course, even for our acquired businesses, the second part of the year is always the more interesting part of the year, where profitability goes up. Yeah, where we will see early synergies coming through. So where on a full year basis, this will hopefully reverse before we see the full potential of the synergies coming through.
Bernd, thank you very much.
And next up is Christophe from BNP Paribas Exane.
Good afternoon, and thank you for taking my question. The first question is on revenue growth and ticketing. When I strip out the first-time consolidation effect of your various M&A transactions, I arrive at mid-single-digit organic growth rates over the last 3 quarters on average. Is this a new run rate going forward for the business, and what is needed to return to double-digit growth rate in the future? This is question number 1. And question number 2 is related to the US and your expansion plans. Here, it would be helpful if you could give some indication about the reserved budget for organic and inorganic growth going forward. Thank you.
Let me start with the second one. So we do not have a reserve budget for M&A or for inorganic growth. Not saying we buy everything what we can, but I mean, we look at each opportunity separately and whether this can be value accretive for our shareholders and fit our portfolio. And we, do our valuations on a standalone basis always. And we do not have a reserve budget for this. And if it doesn't make sense, we will definitely not enter in a transaction. And if it makes sense, then we will be even, and our balance sheet, of course, there's plenty of room for also, getting external resources to close the transaction. So this is, I would say, we don't have a budget, yeah? Short answer. Regarding,
and your question regarding revenue growth and what the underlying organic growth is, I think when we start off with the current quarter and really put it on a clean comparative basis, so really taking the dilutive impact in Q1 2025 out from the acquisitions from Billet and C-Tickets, and to be fair, take out these blockbuster effects in Q1 2024, you would have seen some underlying organic growth of some 6 to 7%, yeah. But the more important thing for us is, of course, whether our operating leverage is still intact. Because if you adjust this or do this math and go down to EBITDA, you would have seen a disproportionate EBITDA growth, yeah. So that's a very important indicator for us that we still benefit from economies of scale from the underlying growth, which is what we see. With regards to what you said to more previous quarters, I must say that whatever in Q4, Q3 last year, if we assume an underlying market growth somewhere in the mid-single digit, then I can say that CTS Eventim has outperformed the underlying market growth, which is always what we've said. Yeah, and given the projections from various industry reports that global live entertainment, European live entertainment is set to grow from a market perspective somewhere at a mid-single digit percentage on average until 2030, that we consider ourselves to be good positioned to outperform this it might always be, of course, difficult if we look at individual quarters year-over-year. After having said that, this is a question of timing, and this is why we have introduced the GTV, which is reported on a rolling 12-month basis, because this one is canceling out the noise, and there you have something like a proxy on the very overall transaction value, which we are processing, that we are growing this in a mid-single digit to higher single-digit percentage rate. So from that perspective, we feel very much on track for what's to come.
Thanks a lot.
Thank you.
There are no further questions.
Okay, that leaves us with saying thank you for giving the time to go through our Q1 presentation with Holger and giving us your questions. Thank you very much, and see and speak to you all again at the end of August then. Take care, all the best. Bye.